Good morning. It's 9:30, so we'll get going. Welcome to the Nottingham Financial Group Weekly Market Update call. My name is Charlie Perrillo. I serve as the President and Chief Executive Officer of Nottingham Advisors. I'm joined today by Christopher Hacker, our Senior Equity Strategist, and Karissa McDonough, Senior Fixed Income Strategist, both with our Nottingham Trust Group. Although running out of steam by week's end, stocks advanced last week despite mixed economic data. All major indices were higher, led by small caps and foreign equities. Kris will provide color later in this call, but on Tuesday, we started off with a report on CPI, and yes, the Federal Reserve is more focused on PCE, the Personal Consumption Expenditures Index. Nonetheless, CPI rose 0.2% and was in line with expectations and slightly lower than June's 0.3% pace. Year over year, the annualized rate came in at 2.7, which is 0.1% better than expected and also matched June's annualized pace. However, food prices were flat. That is, there was no pickup in prices there, and energy prices fell. Those are good things. But if you strip those out and you get to the so-called core inflation was up 0.3% and was up 3.1% on an annualized basis, which reflected an acceleration from the 2.9% increase in June, and it marked the fastest pace since February. Under the surface, one of the bigger items there was medical care costs, which actually were up 0.7%, and that was the highest level since January of 2022. Additionally, there was more evidence of tariff impacts seeping in on items which typically are imported. You could see some price inflation there. Then we had some welcome news in midweek. We had an upturn in small business optimism, which the market reacted to very favorably, but in some respects was something of a backhanded compliment. The National Federation of Independent Businesses, their optimism index rose more than expected, increasing 1.7 points to a reading of 100.3 in July, and that was a 5-month high. The expectations were for that number to run to 98.9. So it was a good number. However, if you look at the details, it was less bad. 84% of owners reported that now is not a good time to expand their business, and that was down from 89% the month prior, with 36% of those respondents expecting a better economy, which was up from 22% in June. So the overwhelming amount of respondents reported that it's not a good time to be making business expansion plans, but that pessimism is less pessimistic than it was in the prior month. So we did have that. However, that was followed by a surprisingly high print in producer prices, which rose 0.9% versus expectations of a 0.2% gain. This increase represented the largest monthly increase in 3 years. Core PPI also advanced 0.9% in the month, and the 3.7% annualized pace was significantly higher than June's 2.6% advance. On an annualized basis, core PPI is up 3.7%, and of course, that's a number that's a little bit higher than the Federal Reserve would like to see. We did end the week with some positive news, though. Retail sales continued to remain solid. They rose 0.5% versus expectations of 0.6%, and it was positively viewed, even though it was slightly lower than June, because June was also revised upward to 0.9%. The previous print had retail sales rising 0.6% in June. So retail sales numbers were pretty good. 9 of the 13 subcategories were higher, so the advance was broadly based. It wasn't driven by one particular sector. Interesting, if you look at a year-over-year basis, retail sales are now up 3.9%, which is a slower pace than June's, where the annualized run rate was 4.4%. As we headed towards the end of the week, jobless claims were in line with expectations. coming in at 221,750 versus June's reported, the prior week's reported 221,000. And towards weekend, the University of Michigan Consumer Sentiment Index saw a modest dip, falling from 61.7 to a level of 58.6. So through the data that came out last week, you see employment figures remain steady, the economic growth remains intact, and we see evidence of inflation edging up. Karissa will have more on that in the fixed income section, because this will actually, plays into how the Federal Reserve is thinking about whether or not they should be cutting rates or leaving them where they are. So as we move into this week, the economic calendar is going to highlight the housing market. We have the National Association of Builders releasing their market index today. Tuesday, we're going to look at housing starts and permits, and July's existing home sales will be reported Thursday. Later in the week, we also get a look at the minutes from the Fed's July 29th through 30 meeting, which will be released. Thursday, again, we get the weekless jobless claims, the Philly Fed Index, and we'll get a preliminary report on August's manufacturing, service, and composite PMIs from Standard & Poor's. The big news, though, and probably the most impactful news, is the annual Jackson Hole Economic Symposium, which is an annual conference held August 21st to 23rd this year. It's hosted by the Kansas City Fed, and it's attended by the world's top central bankers. Fed Chair Jerome Powell will be delivering a speech which will be widely followed and reported on. And as the Fed looks to navigate across a host of mixed economic data points while fielding pressure to lower rates, it's going to be very interesting to see, what his comments are. So with that, it's a good segue to turn it over to Karissa McDonough, the Senior Fixed Income Strategist for Nottingham Trust. Thanks. Karissa?
Thanks so much, Charlie. And that was a great segue. So if we recall where we were a couple weeks ago, Charlie covered a fair amount of the economic statistics that have come out, but we saw a big drop in interest rates 2 weeks ago when we saw that surprising July jobs report. And since then, we've had different data come through. I think that inflation data that Charlie just referenced with the producer price index, that had a little bit of an impact, but rates have generally been treading water here over the last 2 weeks. And we are really looking forward to Friday. That is going to be the most impactful part of this week, at least in terms of the bond market. But you can see I put on this slide, just for comparison purposes, what the broad bond market has returned year to date, about 4.5%. And we had that incredibly big move at the very beginning of August with the jobs data. So not a lot of change in the interim. The long end of the curve, long rates have moved up to a degree. Again, we see long rates more reactive to inflation data, and that may have been the thing that moved long rates up here. But this week, we're waiting for a fair amount of data to come through. So if we want to go to the next slide, please. Jackson Hole, that is the top of mind for bond investors this week. This has historically been a really significant platform for Powell or whoever the Fed chair is to come out and make kind of broad proclamations about policy, both about the near-term direction of rates in terms of what the Fed plan is, and also more of a framework review, and I'll get into that later in this discussion. But we've seen historically that rates can have be impacted pretty significantly from whatever comes out of this meeting. And this chart that I'm showing on the right-hand side shows the 2-year Treasury yield reacting to whatever comes out of the Powell speech. And you can see 2024 2-year yields dropped pretty significantly. Powell had said that the Fed is on the precipice of cutting rates. That was last year's. A couple of years ago, it was after COVID-fueled inflation, and Powell had said that the Fed's fight on inflation might bring pain to households and businesses. And we did see a concurrent almost 0.75% increase in 2-year yields after that discussion. And again, I know I've mentioned the jobs report repeatedly. It seems to be one of the favorite statistics that the Federal Reserve uses. We're going to see that data come out September 5th. So it maybe will come down to that. And we are also aware that the Fed really wants to be data dependent. They want to show that they are acting independently at this juncture. So we want to go to the next slide. So again, if you look at these two charts, they're telling two different stories. The jobs report, you can see the initial release is in that dark yellow. The revisions are in the gray, and you see a significant set of revisions to May and June. We've discussed this, and July's report was much lower than kind of the last several months. And then you can see consumer and producer prices on the right-hand side here. That producer price number that Charlie had referenced earlier, that was quite a bit higher than had been anticipated. There is a lag. There tends to be a lag between producer prices and consumer prices. Producers will pass that through in their pricing to consumers. So there still is some risk that the impacts of tariffs, that is a lagged impact on the consumer. So I think it's too early for the Fed to claim victory over inflation, and this is why we're going to be so focused on their comments on Friday. If you want to go to the next slide. And I've shown this slide a couple weeks back, the significant increase, that's a flipped chart on the left, in market-based pricing of a potential cut in September. We're now at over 80% chance of a cut in September. Still, the market is still pricing in 2 cuts through year end. That producer price index wasn't enough to change that possibility. 5 cuts through the end of next year. Again, that's looking longer term. Again, we're really going to have to look at the data that's coming through near term and hear how the Fed is thinking about things. It's data dependent, but also kind of the context in which the Fed is operating. So next slide. Here, this is where Powell might feel a little less pressure, and he can kind of expand on the Fed's thoughts. Every 5 years or so, the Fed goes through something called a policy framework review. And the last one that they tweaked was 2020. And these tweaks were in response to kind of a tepid economic kind of growth after the financial crisis, et cetera. And, they were also looking at COVID. So they said, you know what, we can let inflation overshoot its 2%. Don't worry about a strong labor market. You don't necessarily have to hike right away. Well, this is somewhat ill-suited to the current environment. So we wouldn't be surprised to see these tweaks taken out and have the Fed much more focused on its dual mandate and adhering closely to it. But that's another thing that the bond market's going to watch for in terms of policy making going forward. That's going to be pretty interesting to hear about in the current environment. And one more slide, I believe. I talk a lot about the Treasury market and corporate bonds. Sometimes it helps to look at other corners of the bond market just to get a sense of kind of the health of the consumer. We talk a lot about different economic statistics. Sometimes things show up in kind of the payment histories. I thought that these charts were really highlighting some near-term trends that we ought to be looking at. So I don't always talk about the asset-backed market or the securitized market. We talk about mortgage performance here and there, but what I'm showing here is kind of the health of the consumer in a different light. You can see consumer debt by type in terms of trillions. Mortgages are the vast majority of consumer debt, but you can also see other little slivers here. Credit card debt in blue, you can definitely see that that's starting to increase. Home equity loans are increasing as well. That's in the red. And student loans are something else that's kind of increasing here as well. And I think on the right-hand side, now that student loans are back in official repayment status, these are 30-day delinquencies, and that's kind of skyrocketed. So if you have consumers that are having to all of a sudden service this debt that they weren't having to before, that's going to flow through to their credit scores. That's going to make it harder for them to qualify for other credit. It'll be more expensive. This could have a knock-on effect on other pockets of the consumer and other parts of the bond market. So again, I'm not saying it's a 5-alarm fire at this point, but we need to be cognizant when we have pockets of weakening in the consumer that could flow through to other parts of the economy. So thank you so much. Those are my comments for today, and I'd like to turn it over to Kris Hacker, our senior equity strategist. Thank you.
Thanks, Karissa. So looking at equity markets, we had a second straight week of gains, making it the fourth positive week in the last 5 weeks, as we've seen that continued rally. The S&P 500 has recaptured its all-time highs and ended up the week about 1%. Interesting side note there is that this year the S&P 500 has closed at a record high in 17 days so far this week, or excuse me, this year. The NASDAQ, lagged the S&P 500, was only up 0.8%, but still in the positive. We saw Dow Jones, really the outperformer of the group, up 1.7%. Question is, was this a rotational week? Well, by some measures, you'd say yes, given the fact that the Dow Jones did outperform, which is a bit unusual compared to the weeks and weeks of growth rallies we've seen. And you also can see that by looking at the Russell 1000 and the Russell 1000 growth and value indexes, where we saw a value outperforming by about 65 basis points. That's a bit of a trend reversal, given that year-to-date growth is outperforming value by 4%. Nice to see small caps have another strong week as well. The S&P 600 ended up 3.2% on the heels of being up 2.2% last week, and that pushed the index into positive territory by a few basis points. Up until this point, small caps were the only major index that was negative on the year, but with these back-to-back strong returns, we've seen it push into positive territory. Internationals continue to show strength. The MSCI ACWI ex-US ended up 1.9% on the week, and the MSCI Emerging Markets Index up 1.6%. That continued strength we've seen in internationals all year long. Next slide, please. From a sector-by-sector basis, healthcare outperformed, up 4.7% this week. Haven't said that for a while. That was really spurred by Berkshire Hathaway's announcement that they're taking a stake in the beaten down United Healthcare company, and that also brought rise to quite a few different companies, all in the health insurance business, and also Big Pharma had a bit of a rebound. Looking at companies like Eli Lilly, Incyte Pharmaceuticals, Vertex Pharmaceuticals, all having a very strong week. Consumer discretionary also outperformed this week, up 2.5%, but it was more of a broad-based rally tied to the digestion of the retail sales number. And that's an important fact, that it was a broad-based rally. Consumer discretionary tends to be a highly concentrated industry, really led by Tesla and Amazon, taking the lion's share of the weight in that index. But to see companies broadly spread out, that's typically only you see in an environment where you see tied to more of that economic data, really retail sales, which was the catalyst for the strength in that sector. On the other side, consumer staples were the largest outperformers, down about 70 basis points, and it really reacted negatively to the CPI and PPI reports. My interpretation of that is that you saw high producer price indexes, lower consumer price indexes. I think there's concerns there of a margin squeeze taking place if they're not able to pass on those costs. And again, consumer staples tend to be a high volume, low margin type industry, so that's why you see that type of reaction. You also saw some negative reactions in the utility space. That was also down about 70 basis points. Not really a particularly large catalyst for that one. I think you saw some gain taking in clean energy. Companies like Vistra, Constellation, NRG were down the most. And I think that was also a reaction to some of the earnings that we saw this week. So Applied Materials fell off a cliff, down 14%. So Applied Materials is a company that produces equipment that semiconductor companies use. So they have the equipment, they come in and they have the equipment, does the etching on the semiconductors, they help produce the wafer boards, all the inputs that go into semiconductors. So the fact that there's some slowing down at the largest semiconductor equipment producer did bring some concerns that maybe there's going to be a slowing down in the semiconductor industry, and then utilities are adjacent to that because it's the energy supplying the data centers. All of that was kind of some of the factors going in there. We also saw Cisco Systems have a pretty negative earnings reaction, down a little less than 8%. Again, that's more on the hardware side of technology. So you have Applied Materials and Cisco both on the hardware side. Earnings reactions weren't optimistic. And then you see Deere also had a negative earnings reaction, down about 4% as well, as they just saw some potential slowing in some of their inventory managements. When you look at earnings coming up, we do have some meaningful earnings reports coming up this week. Tonight, we're going to have Palo Alto Networks come out, a large cybersecurity company, and that'll give us insight into some of the software spending that we're seeing. Tomorrow morning, we're going to see Home Depot and Medtronic. On Wednesday morning, we're going to see TJX companies, Lowe's and Target, and then we're going to see Walmart come out on Thursday morning. And that's going to give us a bit of insight into the health of the consumer. So when we're talking about these the retail sales report that we mentioned, you look at a company like Walmart, Target, Lowe's, Home Depot, TJX, large big box retailers in the U.S., those could have some meaningful impacts on the market. But really, I think what's going to be driving a lot of volatility will be next week when we have NVIDIA, the bellwether of this AI rally, report their earnings. Next slide, please. So just to illustrate a few things here, we see a lot of green, but on the right-hand side, just want to highlight, all the all-time highs that we've hit over the last couple months. You take a look at the S&P 500, NASDAQ, the MSCI ex-USA, so your international indexes, and a variety of different sectors such as IT and utilities, your financials, industrials. They're all hit all-time highs within the last month, and that's just giving again some of the credence to this this momentum-based rally that we've seen in a variety of different industries. Some of the other industries still have a ways to catch up. We've talked a bit about small cap being undervalued, and meaningfully, when you look at small cap and mid cap, well below their all-time highs. Emerging markets, healthcare and materials, energy, all areas where we're well away from when they peaked. So looking at that chart, what does it tell us? It tells us the momentum still continuing in the sectors that we've seen a lot of strength in. Looking down at some individual stocks, I think these also reflect a lot of what we've spoken about already, with United Health leading the way, Eli Lilly rebounding, and then you see some of the movements with some of the other stocks that were on earnings related. And then on the bottom, Cisco, Deere, again, two of the ones that were on the downside. And just, again, you can see the trend throughout the year, that a bit of a different year when you see what's been up versus down. But again, looking at year to date, NVIDIA, Lam Research, all technology Corning, near the top of the market. So with that being said, that's all that I was going to cover here today, unless there is any questions for myself, Karissa, or Charlie.
All right. Well, without any questions, we can adjourn this meeting. Thanks for joining us and look forward to seeing you again next week. Have a great week, everyone.